Welcome back to the Working Thesis. I am Maya, and sitting across from me, as always, is Theo. Grab your coffee because today was one of those days where the surface of the water looked completely glass flat, but underneath, there was a full-blown shark attack happening. We are looking at the close for Wednesday, July 15th, 2026. And on the surface, if you just glanced at a screen, the indexes closed green again. They were riding the momentum of a second straight cool inflation report. It really looked like a calm, happy, risk-on summer day where everything just effortlessly floats higher.
It really did look that way from a distance. But if you own anything in the hardware space outside of a few specific megacaps, you're probably looking at your portfolio this afternoon and wondering what on earth just happened. Underneath that calm green surface, memory chips were being systematically liquidated. We saw some premier names down 8 or 9% in a single session, with massive volume behind the selling. This was a classic rotation, but it was wearing a broad rally's clothing. Money was fleeing one highly specific, crowded theater and hiding in the megacap safety trade.
That is the perfect way to phrase it. A rotation in disguise. The core question we are going to sit with today and unpack deeply over the next 15 minutes is this. Is the entire AI chip trade finally cracking after a historic run? Or is this just a highly specific liquidation in the commodity corner of that market? Let us get right into the numbers.
Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research. Let us run the scoreboard first to see the illusion. The Dow rose 0.29% to close at roughly 52,659. The S&P 500 added 0.38% to finish at 7,572. The Nasdaq Composite led the Big Three, gaining 0.62% to close at 26,269. And the small cap Russell 2000 also joined the party, rising 0.39%. Broad, steady, and uniformly green across all major capitalizations.
And just to reinforce how remarkably calm it looked from the top down, the VIX, Wall Street's primary fear gauge, actually fell a full 5% to sit at about 15.7. If you only check the headline indexes and the headline volatility metrics, you would assume everyone just went home early and happy, enjoying the low volatility. But that broad green scoreboard completely hid a violent structural split taking place directly underneath the hood of the market. The primary fuel for that index-level calm was the inflation data we got this morning. June's Producer Price Index, which is our main wholesale inflation measure, came in undeniably cool. Headline producer prices actually fell 0.3% for the month and rose 5.5% from a year ago. That year-over-year number was well below the 6.2% that economists had expected, and it marks the lowest reading in 3 months. For a market obsessed with the Federal Reserve, this was exactly what the bulls ordered.
Exactly. And the bond market loved it immediately. Yields fell to about 4.55%, and you saw rate hike bets ease across the board. The mechanics here are straightforward. If wholesale prices at the producer level are cooling down, the theory is that consumer prices will eventually follow suit, giving the central bank room to breathe. The headline number gave the broader market its green light to keep buying.
But to be honest about the nuance here, and we always try to be, it was not a perfectly clean macro cooldown. The drop was largely energy-led, driven by falling wholesale fuel prices. If you strip out energy and look at the core rate, it actually firmed up just a touch. So the sticky parts of inflation are still somewhat sticky. Still, in this tape, a cool headline is all the algorithms and the passive flows need to aggressively hit the buy button on the major indexes.
But now we have to talk about the damage under the hood, because the contrast was severe. The memory and storage complex was just hammered today. Micron fell a brutal 8%. Western Digital dropped almost 9%. SanDisk fell 8%. Marvell dropped over 7%, and Seagate fell almost 6%. It was unrelenting, all day selling pressure across the entire storage board.
It was a complete bloodbath in that specific cohort, and it inevitably dragged down the broader semiconductor ETFs too. The SOX closed down 2.2%. Even the premier equipment names caught some of the shrapnel, with Lam Research slipping about 3%. When you see names of that quality dropping mid to high single digits on a day when the Nasdaq is broadly up, you know something structural is shifting in the background.
Right. This was not broad market panic, and it was not a macro event. This was a highly concentrated, specific, and aggressive liquidation in the memory sector. People were hitting the sell button without waiting to ask questions about valuations or long-term demand. And to understand why that happened, we have to look at what occurred overnight in Asia.
The spark for all of this chaos was out of China. Changsun Memory Technologies, widely known in the industry as CXMT, announced plans to raise about $8.6 billion in an IPO. That makes it Asia's biggest initial public offering of the year so far, and notably, the company completely doubled its original fundraising target because of massive institutional demand.
And the global market knows exactly what that money is for. It is going to radically accelerate their DRAM memory production capabilities. CXMT has been growing at an astonishing rate. Their revenue reportedly jumped more than 700% year over year, and their share of the global market has quietly climbed to roughly 8%. That is no longer a rounding error or an experimental project. That is real, highly disruptive scale.
So the fear that gripped the market today is that a massive flood of new Chinese capacity is going to inevitably pressure conventional memory chip pricing. When an aggressive, well-funded competitor suddenly gets an $8.6 billion war chest to aggressively build out factories, the global incumbents usually suffer severe margin compression. That margin fear is exactly what the market was pricing into Micron and Western Digital today.
But here's the crucial distinction, and this is where most of the mainstream headlines totally blurred the reality of the situation today. CXMT competes primarily in conventional commodity DRAM. That is the standard memory that goes into everyday laptops, smartphones, and traditional enterprise servers. They do not, at least for now, touch high bandwidth memory, or HBM.
And HBM is the genuine bottleneck for AI accelerators. You literally cannot run a cutting-edge Nvidia GPU without strapping complex high-bandwidth memory directly to it. Commodity memory and bottleneck. AI memory are almost entirely different businesses at this point in the cycle. They have completely different pricing power, distinct supply constraints, and totally different customer dynamics. They should not trade together.
Exactly. So a sudden capacity fear in commodity DRAM can absolutely crush the pricing outlook for that specific conventional market, while the AI memory shortage stays completely intact. Now, to stay humble, a massive wave of Chinese capacity is a real, long-term overhang for the entire semiconductor space that is absolutely worth watching over the next few years. But conflating commodity DRAM with the AI memory bottleneck is a fundamental mistake. And it looks like a mistake the tape made today in its panic.
And we have a major tell that proves this was a targeted rotation and not a systemic collapse of the AI thesis. On the very same brutal day for memory stocks, the AI architects and the primary foundry held their ground perfectly. Nvidia was basically flat, finishing up 0.3%. Broadcom rose 1.3%, and Taiwan Semiconductor was down just a tiny fraction of a percent.
That price divergence is everything. The brilliant designers of the complex AI chips and the premier company that actually manufactures them did not break at all. Only the commodity memory makers and the second-tier hardware names absorbed the selling pressure. The takeaway here is that within that one umbrella word, chips, there are very different businesses with very different competitive moats. Knowing exactly which one you own mattered enormously today. And while the memory space was panicking about future supply, we got a massive, undeniable confirmation of the bull thesis from the equipment side. ASML, the Dutch giant that makes the extreme ultraviolet lithography machines necessary to print the most advanced chips in the world, reported a very strong quarter.
They absolutely did. They posted about 9.3 billion euros in sales, but much more importantly, they raised their full-year guidance for the second time this year. They are now confidently expecting 43 to 45 billion euros in sales, and they are doing it at a remarkably fat 54 to 56% gross margin. Their shares rightfully rose over 2% on the news.
This matters deeply because ASML sits at the true, undeniable bottleneck of the entire global industry. A capacity fear like the CXMT news can easily compress the multiples of the memory makers. But ASML just told us, in hard audited numbers, that the multi-year equipment and capital spending cycle underneath all of this AI infrastructure is very much intact. The massive structural spending is still happening.
There was a second structural force pressuring the memory names today, and it came from Korea. This is the exact same story we have been tracking closely all week. The Korean Kospi index fell almost 6% today, and Japan's Nikkei dropped over 3%. That brutal Korean margin deleveraging we saw start on Monday just keeps grinding on without relief.
Right. And that forced, positioning-driven selling in Asia piles directly onto the memory names here in the US. The Korean index is heavily dominated by the big memory makers, specifically Samsung and SK Hynix. So when domestic Korean investors are forced to liquidate everything to meet margin calls, those foundational stocks get hit. That mechanical selling amplifies the fundamental fear around CXMT capacity, creating this vicious downward loop that we saw bleed directly into names like Micron today. So, with semiconductors taking all that structural damage, how did the major indexes manage to stay so cheerfully green? The answer is the exact same as it has been all year. The mega-cap platforms did all of the heavy lifting. Apple rose 4%. Alphabet gained about 3.6%. Amazon added a clean 3%, and Meta rose about 3% as well.
They acted as an absolute fortress for passive money. The communications sector jumped 1.7% overall, and consumer discretionary rose almost 1%, which was definitely helped by those falling interest rates from the cool PPI print we discussed earlier. But it really was just a handful of absolute giants masking the very real, very painful liquidation happening underneath. It is a dominant market pattern we just keep seeing over and over again. Outside of the chip drama and the mega caps, we had a couple of big single stock stories today. Let us stick to the facts. PayPal soared over 17% on a highly detailed report that the payments company Stripe and the private equity firm Advent made a joint takeover offer. The bid is reportedly at $60.50 a share, which values the massive deal at more than $50 billion, representing a premium of about 28%.
That is a colossal potential shakeup in the digital payment space, merging two of the biggest players. We also saw Zillow rise about 6% today. That upward move came after a favorable courtroom setback for the Federal Trade Commission in a long-running case involving the company. Plus, Zillow obviously gets a very nice fundamental tailwind from the prospect of lower interest rates and lower mortgage rates following that cool wholesale inflation data. I want to pivot and touch on two important notes for the physical infrastructure thesis. First, New York State officially imposed a one-year pause on permitting any new hyperscale data centers. You have to read the subtext of that carefully. It reinforces exactly how incredibly scarce grid and power capacity is becoming. It absolutely does not signal any drop in underlying AI computing demand. It signals a hard physical limit on where these massive facilities can actually be built.
Exactly. It is a severe supply constraint on the grid, not a demand issue from the tech companies. And on the fuel side of that vital infrastructure equation, Cameco restarted production at its Cigar Lake uranium mine today after a temporary operational disruption. Crucially, they kept their 2026 overall production guidance entirely unchanged. That is a big deal because it removes a lingering execution overhang for the name, keeping the physical power thesis cleanly on track. Taking a quick look globally, the broader tape definitely leaned risk off outside of the US tech giants. As we mentioned, Japan's Nikkei closed down over 3%, and Korea's Kospi dropped almost 6% on that continuing tech de-risking and margin pressure. Over in Europe, the DAX slipped about 0.6% as they digested the global flow of funds.
We also got some key macroeconomic data out of China today. Their economy officially grew 4.3%, which notably missed consensus expectations. Furthermore, their fixed asset investment fell 5.7%, which is a definitively soft read on domestic Chinese industrial demand. In commodities, oil held steady above $80 a barrel, firmly supported by the continuing Iran geopolitical risk premium. And in the crypto space, Coinbase caught a solid bid, rising about 3.5% on the day. If we step back from the daily noise and weave all this together, the broader picture is actually quite clean. The market is aggressively selling the crowded, conventional commodity memory trade right now, but it is steadfastly continuing to fund the structural AI architects, the software platforms, and the true bottleneck equipment providers.
A sudden, massive supply fear like the CXMT expansion can absolutely compress the multiples of the legacy memory makers. We saw the violent reality of that today. But at the exact same time, the multi-year capital equipment cycle, the exact one ASML just triumphantly reconfirmed for us, keeps running. The single most useful habit on a day like today is knowing precisely what you own within that broad category of chips. This is a likelihood read, not a certainty, and we always want to stay humble as the market evolves and digests new capacities. The massive catalyst that is going to settle a lot of this ongoing debate arrives tomorrow morning. Taiwan Semiconductor reports their earnings before the U.S. Open. You need to watch 3 critical things: their gross margin trajectory, their 2026 capital spending plans, and exactly what management says about sustained AI demand.
That earnings call is the definitive read on whether today's violent memory wobble is just a contained, tactical event driven by one IPO, or if it is the first real structural crack in something much broader. The entire global market will be listening to every word. We are also going to get June retail sales, the weekly jobless claims, and the Philadelphia Fed manufacturing survey tomorrow, so expect plenty of macro noise to go alongside the TSMC print.
Here's the one line to carry with you tonight. The indexes comfortably rose, but it was a violent rotation, not a broad rally. China's capacity fear completely cracked commodity memory, and the Korean unwind piled onto the pain. Yet ASML confirmed the underlying equipment cycle, and the AI architects beautifully held their ground. Not all chips are equal, and today richly rewarded those who knew the difference.
Beautifully said. Remember to do your own research, as none of this is financial advice. Just 2 friends unpacking the daily tape. Thanks for spending part of your day with us. We will see you right back here tomorrow to break down those massive TSMC numbers. Have a great one.
That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.